just how much diversification should you get when it comes to a diversified growth fund? I'm Mark Colgate. This is Institutional Masterclass. To discuss the issue, I'm joined by three experts. They are Mark Parry, Senior Investment Manager at Aberdeen Asset Management, Aniket Das, Vice President at Redington, and Robert Holford, Senior Consultant at Spence Johnson. Aniket, are you worried when it comes to diversified growth funds that correlations are growing? QE has basically meant all risk assets are going up at the same time.
When you look at any kind of diversification, when you start getting correlations heading in the same direction, that does take away from the attractions of diversification. That said, so that affects DGFs, it affects other types of strategies which also use diversification. So as bond equity correlations start to creep upward, any strategy which uses bond equity correlation diversification is going to suffer. It's not going to have the same kind of returns expected going forward as something during a regime where bonds and equities were negatively correlated. And that leads us to kind of getting away from just bonds, equities. Let's look at other asset classes which might still have some diversification benefits. Let's look at some trading strategies which are not correlated to the traditional asset classes.
Well, Mark Parry, are you worried that there's a positive correlation between equities and bonds at the moment?
No, there isn't, and there hasn't been since the days of Alan Greenspan. If you can remember back that far, I certainly can. I think the one thing that might change that would be a re-emergence of inflation in a significant way, or of inflationary fears in a significant way, and that's very unlikely. The point here is that bonds and equities have different drivers. There's an investment seesaw, if you like, going on. As long as that negative correlation is maintained, then a combination of bonds and equities is a better portfolio diversifier than bonds and cash or equities and cash, because cash has asymmetry. Cash can't go up. The best it can do is not go down. Now, in times of market stress, that can be helpful when correlations do indeed tend to rise. And it's also fair to say that the bond-equity relationship has changed somewhat over the last little while. There were certainly periods last year, the so-called taper tantrum, when they did move more closely together. But fundamentally, just look at this year to date. You've had a degree of volatility in equity markets. Bond yields have by and large fallen over time. So they're providing a different pattern of returns. Remember, the coupon reinvestment helps smooth the pattern of bond returns anyway. And yields are not in a hurry to go up because central banks are being very supportive. Inflation is not a problem. Growth is moribund. That's not an environment in which we believe inflationary fears are going to drive bond yields dramatically higher and in the same direction as equities.
But are you worried that whether it's equities or bonds, central banks are sort of printing money and saying, feel good about yourselves, take on risk, and we'll do whatever it is to make you feel happy? So if at some point that gets switched off, it's going to have consequences
I fundamentally disagree with what you're saying about QE. QE has been about underwriting growth in an absolute absence of inflation. A year ago, I don't think anybody would be sitting here thinking, wow, we've had all this growth but no inflation. The fact that people are talking about deflation, it may not be likely, but it's been talked about. Inflation is not high enough anywhere. So there's an obvious explanation for that, which is printing money does not create inflation.
But the correlation between the size of the Fed's the Fed's balance sheet and the equity markets is quite stark, isn't it?
What has the Fed done? The Fed and other central banks have underwritten the recovery. They have engineered a steady, gradual, slower than traditional, but still strong recovery. With that, there has been there's been a fallback in inflation. That's an environment in which, for sure, you're being paid by central bankers not to own cash. That cash is being put into other assets, be they financial or real. So there is an effect of that. But I don't think that the Fed or anyone else has been a cheerleader directly for equity markets. It's been the outcome of that. And remember, we have successfully not had a double or triple dip recession. We've had a steady, sometimes patchy, but still positive recovery, and that's got to be good news for the whole economy and for investors as well.
Okay, Robert, if I could bring you in, and then Aniket, if I could bring you in. As you look at the DGF sector as a whole, are you seeing the exposures to alternative assets starting to creep up or creeping up over time?
We think it's certainly a desire of the of the DGF managers to bring in alternative asset classes. I think alternative asset classes are key to this particular brand. I think what we've talked about has been giving access to alternative asset classes where there previously wasn't any. I think there are some key challenges to that. I think the need for daily liquidity, especially in the DC market, brings in a key challenge. Again, cost as well is kind of trying to keep these at about the 60-75 basis points. Remember, no performance fees either, so those bring in challenges as well. But I think, yes, there is a definite search for genuinely uncorrelated alternative asset classes where possible to bring into the DGF brand.
Okay, sorry, you wanted to come back in on something Mark was saying earlier.
Oh, just earlier, just on kind of bond equity correlation, kind of ignoring the kind of environment we're in, just looking at pure data. If you look at a very long period of time, look at bond equity correlations, you basically see periods of positive bond equity correlation, periods of negative bond equity correlation, and they basically go decade after decade after decade. So one decade you'll have positive, one decade you'll have negative. That's not saying that that's exactly what's going to happen now, but just looking at the data, that's what it shows. So you do see things flip the other way, and in one decade diversification works very well, another decade it doesn't work as well. That's just,
I think if I could just add one last point there. Key is not just understanding the current pattern of correlations, but anticipating future changes. And that's what matters. As you say, when bond equity turns positive, then that will be a different environment for us as investors. As long as it prevails with the negative relationships right now, it still makes sense as a diversifier to hold a combination of those two assets.
Well, could you give us an example, Mark, of something that's not happening in the world at the moment, but you're thinking, do you know what, if this changes, we're going to have to do quite a lot of thinking about correlation and what we do on the portfolio, because you must look at lots of scenarios the whole time. Have you got...
No, absolutely. I think, it's unlikely there's going to be a change to the kind of the Western orthodoxy of policy response post-crisis anytime soon. There's still slack in the labour markets, economies are still growing subpar, there still is, in central banker parlance, not enough inflation. So I think the policy environment is unlikely to change anytime soon. So that suggests a degree of stability. Say inflation would be the big worry that would potentially derail that relationship. But we're always looking for other things to do. We're always looking for other asset classes. For instance, infrastructure is an asset class that we think helps. If we're going to limit our equity exposure to limit volatility, as it's amongst the most volatile of asset classes, infrastructure gives us 5 or 6% of income. It has an equity-like characteristics in the sense that it's listed, has a different set of income streams coming to it, helps us replace some of the return we forego by capping out the mainstream equity exposure. For instance, high-yield bonds might be another one. And I think we're very wary of siloising bonds and equities as kind of growth and non-growth assets. Is actually growth better priced in high-yield or emerging fixed income than it is in mainstream equities, for instance? So it's about how you access that growth, how you put those things together. And remember, diversification needs to be effective. Owning the UK and the US stock market over the last 20, 30, 40 years, very similar pattern of returns, hasn't given you diversity, and a 50% peak to trough drawdown since 2000. We're only just back to those highs in the market. So diversity needs to reduce risk, and sometimes we need to find some other things to go and help us do that.
Aniket, when you're, as a consultant, looking at diversified growth funds, or anyone who says, we diversify our portfolio, we know what all the risks are, and but thinking about this whole time, are you spending more and more time on that, sort of analysing their claims? How do you go about it?
So in effect, it is basically breaking it down in terms of risk factors. So identifying is if manager claims we have a good mix between kind of growth and safety assets, growth and defensive, and some less correlated alternatives as such, where we really want to get granular and look at a kind of detailed risk picture of the portfolio, not just the capital allocations. It's actually looking at the risk breakdown. So instead of thinking I've got 30% in equities, it's more like 70% of my risk is coming from equities, 20% is coming from bonds, and so forth. So it's basically coming with a risk approach and seeing what the true drivers of the portfolio are, and especially getting more granular, looking at individual trades, what the contribution of risk from a single trade is. So that's becoming more key as a consultant, is understanding firstly risk models, risk breakdown, and how the portfolio is basically being driven.
Robert, I think in your survey you were finding that there was anything between 4 and 44% of DGF's asset allocation was in alternatives. But are you finding that sort of new asset classes, for want of a better word, have been invented or discovered in the last few years?
From our research, I wouldn't say that the alternatives allocations in DGFs are really to new asset classes. I think where the innovation is starting to happen is new ways of accessing those asset classes. So we're seeing a growth in people looking at smart beta as a way of potentially accessing different asset classes that have traditionally been much more hedge fund sort of oriented, and also looking at sort of fund of fund structures and sort of slightly reworking the fund of fund model in order to give people access to those asset classes at a lower overall cost. So I think the innovation is happening more in how these things are structured and then presented, rather than specifically finding new asset classes. Although there are discussions on sort of whether cash is an asset class, for example, and those things that are coming into this. I think it's really that sort of access that is the revolution, really.
Do you see cash as an asset class, or as an observer of the market? Do you think the market tends to see it as well?
I think currently not. I think generally, as was mentioned, it is used as a sort of, in certain markets. Back in my manager research days, there was a good number of equity managers in the Middle East, for example, who use it as a way to dampen volatility. The difficulty with cash is always the extent to which you can then get reinvested at the right times and moving in and out of it. There tends to be a tendency among managers who use cash as an asset class essentially to hold it for too long and not have a good strategy for reinvesting it. So I think if you've got that and you can prove that you have a way of moving in and out of it that makes sense and is well managed, then it can be a very helpful sort of way of protecting for significant drawdowns. But it's difficult to say it's actually an asset class in and of itself.
Aniket, what's your take on it? Particularly as you can hold currency, there's a huge number of currencies you can hold your cash in. Does that give it more of an asset class characteristic?
Again, I think the way that we would look at things is on a kind of risk breakdown. So if you're a GBP, a sterling investor, then you're thinking of sterling cash as a non-risk asset. If you're holding US dollars, you're a sterling investor, that is a risk asset. So cash can be a risk asset, cannot be a risk asset. So at the end of the day, it's about whether you perceive this as a risk asset, and that to me determines more whether it's an asset class or not an asset class. So for a sterling investor, cash is not a risky asset, it's the safe asset. So other people will say, but cash, if you're trying to meet an outcome, cash, it might be one of the riskiest things that you can hold. But thinking from a kind of risk perspective, it's not an asset class.
Okay, and we're talking not just about correlations, but where you put your money. Mark, how do you distinguish between strategic and tactical asset allocation when we've got this dynamic process where things are moving the whole time?
The key point here is to focus on the outcome. The outcome is delivering a certain level of return with a certain level of risk. Now, I'd argue, actually, without sounding at all glib or conceited, return is the relatively easy part. You can always find a return somewhere. It's about understanding and managing the risks that comes with that. So I would suggest that a strategic allocation is the combination of assets today with certain levels of risk, with certain levels of historic risk and certain expected returns that are likely to deliver your targets in terms of both risk and return. That may not be the obvious starting point. It may be that equity risk premium are high or low, or that bond yields are high or low. So there's some things that might colour your likely pattern of returns going forward. But also it's the combination of those assets. So what mixture of assets is likely to give you, from a starting point, the right strategic allocation. Then tactically managing that is really going forward from here. Markets go up, markets go down. That's fine. We take advantage of that and protect against that. A change in the strategic allocation would be more down to a big step change, a secular move. So maybe it is the re-emergence of a significant bond yield premium as inflation worries return maybe in the future, or a big re-rating of stock markets. Those sorts of big strategic changes would suggest a change in the strategic allocation.
Okay, so what's your sort of take on, there's been a lot of talk about fund managers, actually stock selection isn't the key place to add value, it's asset allocation. Firstly, do you go along with that? And secondly, do you find that fund management groups, which traditionally had single asset funds, are good at asset allocation? Well,
so I think in terms of stock selection versus asset allocation, that's always a key debate, and in different periods of time, different things dominate. In a kind of benign environment, stock selection has tended to work quite well, whereas in a kind of more macro-driven environment, asset allocation seems to add more value. At least that's the perception. I think when you look at some kind of historical studies, you see that there are about equal amounts of contribution from each of these. So I think it is important to look not just across asset classes but within, and that's what we're seeing employed within a lot of DGFs. Not necessarily actual stock picking within each area. It's more around kind of systematic strategies. So things like the value premium within equities, how to capture that systematically. That's basically the next evolution. It's more around systematic strategies rather than kind of traditional stock picking as such.
Robert, final thought from you. Would you go along with that? There's lots more innovation to come.
I think yes. I think that there, as I've mentioned previously, I think smart beta is one area, and that systematic capturing of value, for example, is an area of innovation that you've seen a few products starting to play with. I think I agree also with the idea that the belief in active management, shall we say, tends to come and go. But I think yes, there is definitely room for innovation in this, and I think specifically also it's how to capture the actual attributes of various asset classes within some of these DGFs. I mean, people have been putting REITs in, but there's a debate there as to whether they're more closely correlated with actually small to mid-cap equities rather than actually the underlying properties you're trying to capture. So I think the innovation really comes between, for these liquid asset classes, how do you actually capture the characteristics that you're looking for in a way that is cost effective and can really fit in with the rest of the challenges of running a DGF. So I think innovation is definitely possible.
We're out of time, we have to leave it there. Thank you very much.